Hello, thank you for tuning in today. My name is Zach Backner, and I'm the Director of Financial Planning here at Summit Financial Consulting. To continue our discussions on investment topics, we're going to be diving into the two main strategies related to investment analysis: fundamental analysis and technical analysis. These refer to the strategies used by fund managers, institutional investors, day traders, and even many portfolio managers to determine what and where to buy and sell different positions. While the argument as to which is better will always be a lifelong debate, we choose to utilize a blend of both of these strategies here at Summit. No one is ever 100% right, so we believe it is prudent to analyze all types of research. Now, without further delay, let's begin. Fundamental analysis is focused on the idea that an analyst should be able to review a company's financial statements and derive a specific stock price for that company. This stock price is referred to as the intrinsic value, and it represents that analyst's price target. If the stock is below that price, then they should suggest investors buy that stock. If the stock's above that intrinsic value, maybe it's overbought, and investors should expect to sell that stock. So what type of factors influence that intrinsic value? If it uses company-specific or economic data, then it's most likely a fundamental factor. Reviewing a company's specific financials is referred to as micro-analysis, and examining the broader industry or examining the economy overall is referred to as macro-analysis. On the micro side, an analyst is primarily concerned with the company's profitability to derive a valuation. If you've ever seen Shark Tank, they use profits and revenues to rationalize a valuation, and that is a form of fundamental analysis. Two of the most widely discussed valuation techniques are earnings per share and price to earnings ratios. Earnings per share, or EPS, focuses on how much money the company is making in relation to the number of shares that are outstanding. Higher earnings, or less shares, will result in a higher ratio. If you are comparing two companies with the same number of shares outstanding, how do you know which one should be priced higher? The answer is the one with the higher revenues. Likewise, price to earnings ratio, or PE ratio, is very similar as it compares a company's profitability to the current stock price. If a company fails to increase revenue, but their stock continues to climb, this will result in a very high PE ratio and may cause the stock to become overvalued and potentially due for a decline. On the macro side, any data that is broader based would fall into this category. This would include looking at the industry trends over the past few years, analyzing competitors, or even looking at the national economy. If company X is being analyzed, but competitors Y and Z have seen declining profits, it may be possible for company X to be faced with the same headwinds. If company X is in the US and we enter into a recession, company X may struggle moving forward. Macro analysis is all about using broader research to determine how a specific company may perform in the future. Technical analysis is often referred to as charting. This is because technical analysts often do not care about any other data than what the stock price shows them. They use a company stock chart to identify trends and predict which direction the stock price should move in the future. One of the main strategies within technical analysis is identifying support and resistance levels. Support is the bottom line that a stock should struggle to break down through within that identified range, whereas resistance is the top of that range that should be a hurdle for the stock in order to achieve higher prices. If either of those lines break, then a technical analysis should expect the price to continue in that direction. Support can be identified by stock hitting the bottom multiple times at the same price, whereas resistance levels can be derived using the same type of ideology, except it is upside potential that is capped when it is hitting its head at the same level. Technical analysts are also concerned with volume and momentum of the company stock. A 1% update on low volume does not provide nearly as much strength as a 1% update on high volume. With more trades being placed, this provides additional confirmation and strength that their identified trend is correct. Momentum can be thought of as the volume over a given period of time. With a high quantity of buy orders, the momentum will be stronger and should continue to trend in that direction. However, it is possible for a stock to become overbought and too hot, essentially. This exaggeration in momentum means that a cool-off period may be expected. Of course, volume and momentum work the same way to the downside as well, when things could potentially reach oversold conditions. Here's a basic example illustrating the support and resistance lines. As you can see, from the start of 2000 to the end of 2009, the S&P 500, or SPY, spent a majority of the time within a rising channel, those purple lines. When the market broke above resistance, it fell back within the range pretty quickly as a failed breakout. When support was lost in 07 and 08, the market fell hard on that reaction. This chart was received from ycharts.com with our added technical analysis channel. Once again, my name is Zach Backner from Summit Financial Consulting. We want to thank you for taking the time today to watch this video. If you could, please like and subscribe to our channel and you will stay up to date on our future video releases. We'll catch you next time.
Summit Financial.
Working with people you trust.